Hi there, a very warm welcome to my Q1 2023 market and economic update. Now before we get into it today, I would just like to wish you a very happy Easter. If you've got the 4-day break, if you're lucky enough to have the Friday and the Monday off, I hope you have a great holiday, a great relaxing break. If you're here in Singapore and only get the Friday off, then I hope you can still enjoy the 3 days as we head into the second quarter. But back to the markets and what is going on globally. It has certainly been an eventful first quarter of 2023. Lots to cover in this video. We have started to see a bit of a recovery in the markets after 2022. And a lot of that is really being brought about by the fact that more and more investors are realizing that we are pretty close to, if not at, the top of the rapidly rate rising cycle. That offers more stability, more certainty, more peace of mind around cash flow, and it is starting to lead to more of an inflow of capital back into investment markets. We're going to touch on a lot of this today, as well as where we see opportunities and what is happening around the globe. So let's dive right in. We're going to start with what is happening in the United States of America. Let's get started. Now in the United States, one of the biggest headlines that has obviously occupied the media for the better part of the last few weeks at least is the collapse of Silicon Valley Bank, and some suggesting, which is completely nonsensical, that this is the start of a more widespread financial issue for our banking system globally. Now in this video update, you've probably already heard of Silicon Valley Bank. I would just like to give you a bit of an overview of exactly what happened and why we don't believe that it's any cause for concern and instead is creating opportunities in the markets for investors to capitalize on. So first and foremost, Silicon Valley Bank, in simple terms, what actually happened? Why did this bank collapse? Silicon Valley Bank itself is an institution in many ways, or was rather, in the Silicon Valley. It's one of the largest banks that nobody's ever heard of. So unless you're a venture capital fund or you're a tech startup in Silicon Valley, chances are you've never heard of this bank. Now, they've been around for a long time. They were the bank of choice for a lot of Silicon Valley players, and they grew very, very quickly throughout COVID. Because what happened when COVID hit was interest rates were at rock bottom, and that meant that money was effectively free. So the deposits on file or with the bank itself grew from 49 billion US dollars to over 209 billion by the end of 2022. Now the bank itself needed to do something with this capital, needed to invest it, needed to put it to work. So they chose that they would invest this money into mortgage-backed securities and into treasuries. So your typical low-risk fixed income style investments to put that money to work for them. Now at the same time, unfortunately for the bank, they didn't hedge the interest rate risk, meaning they didn't really have any protection in place, and the Federal Reserve went on a rate rising spree. We saw rapidly increasing rates throughout 2022, and what happens when interest rates are rising and very, very quickly is fixed income prices start to decline. So the value of their investments dropped. They released their financials at the end of the year in 2022. That highlighted that there was a $17.5 billion hole in the value of these assets. Now that in itself was not that big a deal, sounds like a lot of money, but it's not all that uncommon for banks to have unrealized losses on their books. It doesn't lead to any widespread panic. However, what happened in this situation was that Peter Thiel, one of the biggest names in the venture capital world, told all of his clients to withdraw their capital quickly. He was concerned about these losses. That then spread throughout the Silicon Valley venture capital world, and that meant that there was a bank run. Now, a bank run is when effectively investors or depositors, those that have money with the bank, want to withdraw their money quickly, and they want to do it in large volumes. They want to get out of the bank. They have concerns about its stability. What that meant for the bank was they need to raise that money quickly, which meant they needed to sell these assets that they were already underwater on. They couldn't easily raise additional capital, and hey presto, the bank collapses. So that is what happened. Now, why can't this happen, or why is this very unlikely to happen with other banks around the world? There are a myriad of reasons, but the two key reasons here are: one, banks are not allowed in most developed economies to simply invest in whatever they like. They can't go and put client deposits at huge amounts of risk. There are stringent regulations in terms of what they can and can't do. The second main reason is that the bank's treasury function, which invests and manages the risk for the bank, will often put measures. They will hedge that interest rate risk internally. So these sorts of events typically can't unfold. Their client base is far more diversified, and we don't tend to get this bank run. So we have seen a number of banks, a number of financial institutions sold off on the back of this. Their share price has dropped, and that is where we believe there are some tremendous opportunities in the blue chip end of the market for investors with a medium to long-term view. Now, this has also flowed on to what the Federal Reserve is going to do next, that is the Reserve Bank in the United States, when it comes to interest rates. They've obviously been monitoring the Silicon Valley Bank collapse closely to determine whether it would have any material impact on consumer confidence and the general stability of the banking system. Now, looking at consumer spending, business confidence, consumer confidence, they don't see any reason to be concerned that there is any stability issues or any confidence issues in the US banking system. But the critical question is, what does the Federal Reserve do next when it comes to interest rates? In March, we saw a rate increase from the Fed. We are now at borrowing costs that we haven't seen since 2007 in the United States. Now, that is 15, 16 odd years, so it is a reasonable period of time. But throughout that period, we've had the global financial crisis, we've had Russia, Ukraine, we've had record inflation and interest rates on the back of that. So it's pretty reasonable that we would expect interest rates to be fairly low over the last decade or so. But at the same time, we've got a large group of borrowers or mortgage holders who've never really experienced rapidly rising rates or high rates either. So we are certainly into a different, era in terms of interest rates and in terms of mortgage repayments. Now, that is obviously going to be taking time to flow on to borrowers in terms of the rate increases, but that is the current situation as we see it. Consumer spending is starting to decline in the US, consumer confidence is starting to decline in the US, so the impact of interest rates is starting to be felt in the wider economy. Now, the Federal Reserve doesn't meet again until May, so we're going to have a lot of water flow under the bridge in terms of economic data, inflation data, general spending, unemployment, jobs growth. A lot will flow through and feed into that decision-making process of the Fed at their May meeting. Now, whilst we certainly don't expect we're quite at the end of the rate rising cycle in the US, largely because the majority of their borrowers are on fixed rates, so it takes longer for the Fed to really have an impact on consumer spending, but we do believe that we are closer and closer to the end of the rate rising cycle, which is leading to the inflow of capital back into investment markets. So in the US, we've already seen the NASDAQ, so the technology index in the US, up around 17.5% year to date. So from the beginning of 2023, we do believe there are still some tremendous opportunities in the quality end of the technology space, as well as cybersecurity as a bit of a subsector of that technology sector. We also like financials and healthcare. Financials, again, we have seen a bit of weakness around the cost of capital rising and also the Silicon Valley Bank collapse, creating a bit of instability or just a general amount of volatility in the market there. Healthcare, we're also very bullish on long term, not just because of the aging population, but because of general immigration growth, as well as it being quite an inflation-proof sector. The needs of healthcare, the demands for better healthcare are going to continue to climb. So that's a bit of an update on the US market and what's happening there, where we see the opportunities. Let's have a look at what is happening in the Eurozone. Now, the Eurozone has not been without its own headlines as well. We've seen the collapse, or the takeover, I should say, of Credit Suisse by UBS, two major financial institutions in the Eurozone. Now, some analysts and some journalists in particular have tried to draw a connection between Silicon Valley Bank and the Credit Suisse takeover. The reality is the two are disconnected. Yes, we did see a bit of a bank run on Credit Suisse, but that was really just due to years and years of poor management of the company, poor growth, poor financial management, and hence the takeover of UBS. Now, what it does mean though, by being a larger financial institution, is that the central bank, the European Central Bank, the ECB, will be monitoring general stability, general confidence in the banking system a lot more closely than the Fed will as a result of the Silicon Valley Bank collapse. So we have already seen this flow into the commentary of the ECB, the European Central Bank. We have seen record levels of inflation in the Eurozone. That has most recently come in at 5.7%, and we are going to continue in all likelihood to see the ECB lift rates. However, coming back to my point around monitoring the situation with Credit Suisse, the ECB President, Christine Lagarde, has already highlighted that it is difficult, in her words, to predict the future direction of interest rates for the European Central Bank. So they will obviously be following and monitoring the general stability situation very, very closely there. We do believe, again, this will create some great opportunities, particularly in financials and in healthcare in the Eurozone, but we will be watching this very closely when it comes to how they look to bring that inflation figure down. So that's a bit of an update on what's happening in the Eurozone. Let's have a look at Asia. In Asian markets, it has largely been all eyes on China. China, as you will be aware, has relaxed a lot of their COVID measures late in 2022. That saw a bit of an initial fear, consumer spending dropped, congestion on the roads dried right up, and that was because people weren't quite sure around what's next. Everyone knew that the consumer spending was going to increase in China, and there were some initial concerns that this would lead to a global increase in inflation. Thankfully, that has been far from the truth. The inflation data in China has remained very low, which is certainly a positive for markets, and we have seen the PBOC, the Central Bank of China, keep their interest rates on hold for the 7th consecutive month. So that is certainly good news for the stability of the economy and the stability of global interest rates and inflation, that we haven't seen that flow-on effect of inflation out of China. So with the Chinese market, we remain bullish, particularly on the technology sector and even financials for those companies that can actually expand overseas revenue. We remain a bit cautious around construction and banking within China, just given, growth concerns around how much domestic spending there is going to be, and some concerns around previous construction companies in China as well. Outside of China, in Singapore, outside of the general rental concern, we are seeing opportunities both in financials and in the real estate sector, particularly in commercial. We do believe there is a strong need to be very selective when it comes to the majority of companies in Singapore, but particularly in the commercial property space. Those companies with high levels of debt, given the high interest rate increase that we've already seen, may see their profit margins disappear or certainly be squeezed very tightly. So again, we want those companies, the sectors with strong fundamentals, strong free cash flow from their business operations, reasonable returns on equity, and low levels of debt, because as I said earlier, as that debt looks to roll over, it is undoubtedly going to be more expensive. So again, there are some good opportunities in Singapore. Outside of Singapore, we expect that Hong Kong is going to ramp up more and more incentives to start to bring businesses back to Hong Kong, given the restrictions, the lockdowns we've seen in China, and we fully expect that there will be more of an inflow of new money, new capital, and new corporations looking to expand in Hong Kong as well. So in developed Asia, we certainly see some opportunities. Developing Asia, we're cautiously optimistic, but we'll certainly be watching that space very closely. So that's a bit of an update on what is happening in Asia. Now, on the rental situation with Singapore, not so much an economic update, but I do just want to I guess, shed some light on exactly what is happening with the rental situation in Singapore. As we will all know, rental prices are skyrocketing in Singapore. We're seeing anywhere from a 30 to a 60% increase in rental prices upon lease renewal here in Singapore. And that is really down to three key issues. One, there has been a huge lack of new supply throughout COVID. Nothing was getting built. Two, we are continuing to see strong demand both domestically as families look to live in their own space, and as well as internationally as more and more expats are moving into Singapore. And that's both Australian and European, but also Chinese and Indian expats looking to move into Singapore as well. That is undoubtedly going to increase demand. But the bigger and I guess more sustainable issue is the fact that mortgage rates in Singapore, like everywhere else, have also gone up. So we've seen rates increase from below 1% to above 3%, which means that landlords with debt have a very real increased cost of holding that property. So whilst it is painful that we have to absorb that rental increase, it is very unlikely that it is going to drop in any meaningful way over the next few years. But it's also very unlikely that we're going to continue to see these levels of growth as well. So what I personally expect to happen, and it is just my personal opinion, is that we will see more steady levels of growth in rental prices over the coming years, and that this 30 to 60, 70% increase is just a blip and largely driven by those key factors, as well as the fact that rental prices have largely gone nowhere for the last decade here in Singapore. So a bit of an update on the rental situation as well, I just felt was important to include. Let's have a look at what is happening down in Australia. We've seen a reasonably positive start to the year down in Australia. We've seen the All Ords have a slightly positive start to the year. Now, the only real reason that it wasn't a stronger start to the year for the Australian market has really been driven by the financials. We've seen general volatility in the financial sector globally, obviously with Credit Suisse and Silicon Valley Bank, but we've also seen the cost of capital, that is the cost of acquiring funds by the Australian banks, see quite a stark increase from where they were at last year, with the effectively nearly free access to capital that was provided as a bit of an emergency relief measure throughout COVID to keep the Australian banks strong. So that has led to a bit of uncertainty, a bit of volatility, and we also think that there might be some good opportunities there in the Australian financials as a result. The bigger, more recent news that we've seen in the Australian market has been that the RBA, the Reserve Bank of Australia, has finally put interest rates on hold. This comes after 10 consecutive increases. Rates are now finally on hold at 3.6%. So some good news for borrowers, for those Australians with a mortgage, and some good news for renters as well, as it takes a bit of pressure off the landlords, meaning less costs that need to flow on to renters as a result. Now, the RBA has done this for two key reasons. One is that they want to effectively allow the previous increases some time to flow onto the market, flow onto borrowers. There's usually a lag of around 3 months for borrowers to really adjust their spending, adjust their general confidence as a result of those increases. We also saw inflation come in quite a bit lower than expected. Year-to-date February inflation data was 6.8%, which was well below forecasts of 7.2%. And this was really driven by the fact that airfares have come off around 25%, petrol prices have declined, and building material costs are also declining as well, which we would expect to soften a bit further. Now, these were three of the key variables that led to very strong inflation in Q4 of 2022, which is why we're starting to see that inflation figure decline now. Now, the RBA did highlight that they would still need to utilise further tightening if inflation doesn't come down as quickly as they would like. Their target is still 2 to 3%. There has not been any change there. So they will be monitoring this very closely. So what this all means is that we don't expect that the RBA is going to be cutting rates anytime soon, but we are certainly very close or a lot closer to the end of the rate rising cycle now. And personally, I'm expecting we'll see 1, maybe 2 more increases over the next few months, and that should be enough to start to really get inflation down to where the RBA would like it, albeit it will no doubt be slower than they would like it to be. What we've also seen as a result of this is that the Australian dollar has softened relative to many other currencies, and we would expect that that will continue, particularly relative to the US dollar and therefore the Singapore dollar, particularly if the Federal Reserve is going to increase interest rates more aggressively than the RBA will. That will lead to greater demand for the US dollar and, as a result, in all likelihood, a further weakening of the Aussie dollar. So for expats, good news if we're looking to repatriate money, if we're looking to invest in an investment portfolio in Australian dollars, there will certainly, in all likelihood, be some good opportunities there to be taken advantage of. Now, we have also seen the New South Wales state election very recently, a landslide victory for the Labor Party. Australia has certainly spoken. I believe the coalition government was there for around a decade, so a big change for New South Wales. Now, importantly for our clients and for those with property in New South Wales is what this means for the Australian property market. There are really three key factors or three key things to be mindful of under the Labor Party's leadership. One is they are going to abolish the first home buyer choice program that allowed first home buyers in New South Wales the choice between paying land tax or stamp duty up to a purchase price of $1.5 million. So what that meant is that if that was the only way to get in to avoid that large one-off cost of stamp duty, that is now gone, that whole program. What they are putting in its place is a stamp duty waiver program. So up to the purchase price of $800,000, there will be a full stamp duty waiver for first home buyers, and up to $1 million, there will be some concessions granted. So if you were looking to buy between 1 and 1.5, this isn't the best of news, that is for sure. In terms of what impact this will have on the market, we will certainly be watching that one very closely. We will also see the program being launched. One of the Labor Party's big election promises was to create more affordable housing in New South Wales. This will start with a $30 million project in regional New South Wales to start to stimulate more and more affordable housing in the region with the look to then replicate this program in other areas. So that's a bit of an update on what's happened with the New South Wales election. Not expecting too much else to change there going forward. In terms of the Australian market, a very similar sort of thesis to the rest of the world. We like those companies with strong fundamentals, strong financials and low levels of debt. So again, we are looking healthcare, financials, we believe there's opportunities there, particularly with the Aussie dollar being where it is, as well as the tech sector in certain parts of the economy. Treasury has just announced that they're expecting the population to increase by over 900,000 people over the next 2 years in Australia. So this is naturally not only going to put pressure on our housing market, which is woefully undersupplied, but also in terms of consumer staples, healthcare and financials, we expect that there will be strong demand there. So certainly some opportunities for those medium to long-term investments. I hope that gives you a bit of an insight in terms of what's happening globally and down in Australia in terms of investment markets. If you have any questions at all, please do feel free to book in a meeting. It would be great to catch up, update you on our outlook, any changes we need to make for your own investments. You'll find that link in the email that you'll receive. Any questions at all generally, feel free to drop me a note. But otherwise, thank you very much for tuning into the video. I hope it's been helpful. I look forward to seeing you soon. Thank you.